Did you know that in the first quarter of 2025, the multifamily sector in the United States absorbed nearly 102,000 units, marking a 12% increase from the previous year? This impressive growth highlights the resilience and demand within the multifamily real estate market. Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. The U.S. Multifamily Market Beat report for the first quarter of 2025 reveals a robust demand in the multifamily sector, with nearly 102,000 units absorbed, up 12% from the same period in 2024. This marks a significant increase compared to the pre-pandemic average of around 73,000 net move-ins. The sector continues to benefit from steady household formation and affordability challenges in the for-sale market, with demand outpacing supply for the first time since 2021. The supply side is experiencing a notable shift, with new deliveries in the first quarter totaling 95,000 units, down 25% compared to the previous year. The construction pipeline has decreased by 34% compared to a year ago, bringing it back to 2018 levels. While economic uncertainties are on the rise, the outlook for rent growth remains positive, with a year-over-year increase of 2% in the first quarter of 2025, close to the historical average of 3 to 3.5%. Regionally, the south of the United States is experiencing the strongest demand, driven by significant population growth, accounting for 53% of nationwide move-ins in the first quarter. Notably, Dallas/Fort Worth and Phoenix lead the nation in absorption, with 7,500 and 5,100 units respectively. On a percentage basis, Sarasota and Huntsville absorbed more than 2% of their inventory, indicating a potential recovery in fundamentals despite high vacancy rates. The construction pipeline's contraction is being felt nationwide, with just 545,000 units remaining under construction, the lowest since 2018. Texas stands out with significant declines in construction, particularly in Dallas/Fort Worth, Austin, and Houston, where nearly 60,000 fewer units are under construction compared to last year. This trend is mirrored in other major markets like Atlanta and Phoenix, further emphasizing the nationwide shift. In terms of rent growth, there's been a mild improvement since the third quarter of 2023, when it hit a low of below 1.5%. Recent quarters have shown consistent, albeit slight, increases, with the latest figures showing a 2.02% year-over-year growth. The Northeast and Midwest are leading in rent growth, with the Northeast Arkansas and San Jose markets showing notable increases. However, markets like Austin and Denver are experiencing rent declines due to robust deliveries. Regency Centers is making significant strides in Miami with its Avenida Biscayne redevelopment project. This initiative involves a major investment of over $20 million in transforming 3 retail buildings, totaling more than 28,000 square feet in Miami's affluent Aventura suburb. The redevelopment emphasizes an outdoor-oriented dining experience, featuring large canopies that enhance the ambiance for restaurant patrons. Regency Centers has curated a diverse roster of tenants, aiming to position Avenida Biscayne as a signature destination in the area. Among the signed tenants are Roche Bobois, known for its high-end furniture, Hamoen, a cafe and bakery, Bulla Gastropub, Laser Away, Sugared and Bronzed, Sana, Chewy, and Sweat House. The project is strategically located on a prime corner in a regional shopping trade area, offering excellent visibility, ease of access, and ample parking. Some spaces have already been delivered, with more to follow in the coming weeks, and openings are expected later this year upon completion of build-outs. Regency Centers' approach in Miami reflects broader trends in the commercial real estate sector, where open-air, grocery-anchored shopping centers are seeing renewed interest. These centers serve as community hubs, benefiting from steady foot traffic driven by necessity-based retailers and service providers. The company's strategy of transforming underutilized properties into vibrant modern spaces aligns with current market demands for sustainability and community-focused developments. By staying ahead of trends and fostering community engagement, Regency continues to play a pivotal role in shaping the future of real estate in South Florida and beyond. Commercial real estate delinquencies are becoming a growing concern, particularly in the lodging and warehouse sectors. The sentiment in the industry is currently on a downward trend, as evidenced by the CRE Finance Council Board of Governors Sentiment Index. This index saw a significant decline of 30.5% in the first quarter of 2025 compared to the fourth quarter of 2024, marking the largest drop since the start of the COVID-19 pandemic. The index's current value of 87.9 is the first time it has fallen below 100 since the pandemic. Delinquencies are also on the rise, with the latest TREP commercial mortgage-backed securities report indicating that the CMBS delinquency rate increased by 38 basis points to 7.03% in April. This is the first time the rate has surpassed 7% since January 2021. Contributing to this increase are delinquencies in the multifamily and lodging sectors. Nathan Cohen, head of the commercial real estate division at LBC Capital Income Fund, has expressed concerns about the looming delinquency issue in the commercial market. He highlighted that, despite substantial rent increases, property valuations have compressed, with valuations now sitting at about 10 times gross, compared to 15 or even 18 times in previous years. Cohen pointed out that the market is at a stalemate due to affordability issues and buyer expectations. Sellers are reluctant to sell because they cannot find suitable replacement properties, and borrowers are not willing to accept the current market offerings. Banks are also holding on to loans, even if they are not performing well, due to the difficulty of replacing loan debt in the current lending environment. Cohen speculates that banks are avoiding clearing bad loans off their books because it would significantly reduce their loan balances, and originating new loans would be challenging. The impact of tariffs, particularly on imports from China, is expected to exacerbate the delinquency situation. As imports slow down, the commercial real estate market, especially industrial, will feel the effects. Cohen noted that while multifamily properties remain relatively safe, the industrial sector faces risks if large warehouses remain empty and unable to meet mortgage obligations. Cohen also mentioned that the general public would start noticing the severity of the situation when warehouses and hotels begin to close due to delinquencies. This would lead to job losses and could potentially draw more attention to the issue. There is speculation that larger corporations may purchase properties in default, similar to the trend seen in the rental housing market. This could lead to a situation where these corporations become significant landlords, impacting the dynamics of the real estate market further. Despite these challenges, Cohen believes that loan deals are still possible if all parties have realistic expectations. He advises property owners with matured loans to consider refinancing, even if it means accepting less favorable terms, as opportunities for cash-out refinances are limited. In the Asia-Pacific region, commercial real estate is showing remarkable resilience despite global economic uncertainties. According to a report by Cushman & Wakefield titled Trump 2.0, The First 100 Days, Implications for the APAC Economy and Property Markets, the region's property markets are underpinned by strong domestic drivers and market fundamentals. The report highlights the impact of policy shifts during President Trump's second term, particularly concerning U.S. trade, tariffs, and deregulation, which have introduced volatility across global markets. The report notes that while the Asia-Pacific entered 2025 with strong momentum due to resilient domestic demand and continued investments in real estate, the policy turbulence is expected to moderate growth. Businesses are adopting a more cautious approach to decision-making, but the region's strong fundamentals are helping to cushion the impact. Real estate markets remain resilient, although delays in business and investor decisions pose risks in the near term. Key highlights from the report include a slower growth outlook with rising U.S. recession risks and signs of stagflation pointing to softer global growth in 2025. However, a stronger U.S. performance is anticipated in 2026, which could provide tailwinds for the Asia-Pacific region. Trade disruptions, particularly in manufacturing sectors exporting to the U.S., are also noted, but ongoing supply chain diversifications are benefiting industrial hubs in Southeast Asia and India. The resilience of the real estate sector is underscored by solid occupier and investor demand for commercial real estate, with office space absorption continuing across key markets such as India, Indonesia, and the Philippines. The net absorption of office space across the Asia-Pacific in the first quarter of 2025 is approximately 26 million square feet, a 20% year-on-year increase from the first quarter of 2024. Global capital flows into the Asia-Pacific real estate market are driven by the strength of the US dollar and relatively attractive yields. This is particularly evident in stable sectors like logistics, data centers, and multifamily properties. The downward trajectory in interest rates is also expected to boost investments in the commercial real estate sector. Dr. Dominic Brown, head of international research at Cushman & Wakefield, emphasizes that while risks are elevated, historical trends suggest that the Asia-Pacific property markets are well positioned to rebound quickly once greater global clarity emerges. It is essential for occupiers and investors to remain nimble and adjust their strategies to ride the wave of recovery when it happens. From staff reports, Wingstop has leased a retail space of 2,156 square feet at the Village Shopping Center located on 3 Chopped Road in Henrico. This move is part of Wingstop's expansion strategy, aiming to increase its presence in key markets. The Village Shopping Center is a prime location, offering excellent foot traffic and visibility, which aligns with Wingstop's goals of reaching more customers. This leasing activity reflects the ongoing demand for retail spaces in strategic locations, as businesses look to capitalize on high-traffic areas to boost their market presence. The retail sector continues to be a significant component of commercial real estate, with restaurants and food service providers leading the charge in occupying available spaces. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.